Welcome to the introduction of the double exponential moving average strategy, a powerful technical analysis method used by traders worldwide. The double EMA strategy uses two exponential moving averages of different time periods to identify trend direction and potential trade opportunities. Let's visualize how this works on a price chart. First, we plot a shorter period EMA, typically the 9-period EMA, which stays closer to price and reacts more quickly to price changes. Then we add a longer period EMA, typically the 21-period EMA, which moves more slowly and helps identify the broader trend. When these two EMAs cross, they generate trading signals. A bullish signal occurs when the faster EMA crosses above the slower EMA, while a bearish signal happens when the faster EMA crosses below the slower EMA. The double EMA strategy offers several key advantages over traditional moving average strategies. First, it reduces lag compared to traditional moving averages, making it more effective for catching trends early. The strategy provides more responsive signals in trending markets, helping traders enter and exit positions with better timing. Double EMA works best in trending markets, where the crossovers can help identify the beginning and end of significant price moves. Finally, the strategy helps identify potential entry and exit points based on EMA crossovers, providing a systematic approach to trading. As we continue through this course, we'll explore exactly how to use the double EMA strategy effectively and maximize its potential for your trading. Now let's understand the concept of double EMA strategy. The double EMA strategy typically involves using two exponential moving averages with different periods. We have a shorter period EMA, which reacts more quickly to price changes, and a longer period EMA, which responds more slowly and smooths out market noise. Here we see a bullish crossover. Here we see a bearish crossover. When the shorter EMA crosses above the longer EMA, it signals a potential bullish trend. Conversely, when the shorter EMA crosses below the longer EMA, it suggests a potential bearish trend. Traders use these crossovers to identify the current market trend direction. The relationship between these two EMA lines helps traders identify the current market trend and potential reversal points. The double EMA strategy relies on specific period combinations. One popular set is the 9 and 21 period EMAs. These EMAs create crossover signals when the shorter period line crosses above or below the longer period line. Another popular combination is the 12 and 26 period EMAs, commonly used in the MACD indicator. For longer-term trading, the 20 and 50 period EMAs are commonly used, providing fewer but more reliable signals. When selecting EMA periods, traders face important trade-offs. Let's examine how different period lengths affect trading signals. Shorter periods between 9 and 12 provide high responsiveness but generate more false signals. Medium periods between 20 and 26 offer a balance between responsiveness and reliability. Longer periods of 50 or more provide more reliable signals but react more slowly to price changes. Different trading timeframes call for different EMA period settings. Finally, consider adjusting your EMA periods based on the specific asset class you're trading. Forex pairs, stocks, and cryptocurrencies each have different optimal settings. Remember to choose your EMA periods based on your trading style, time frame, and the specific asset being traded. The right combination will help you find the balance between responsiveness and reliability. Let's examine how to identify bullish signals using double exponential moving averages. In a double EMA strategy, we typically monitor two EMAs of different periods, a shorter one and a longer one. A primary bullish signal occurs when the shorter period EMA crosses above the longer period EMA. This is known as a golden cross in the double EMA context. This crossover suggests momentum is shifting upward as the faster EMA responds more quickly to recent price changes. Traders often use this signal as an entry point for long positions, looking to capture the potential upward trend. The most reliable golden cross signals often occur after a downtrend, indicating a potential reversal and the start of a new uptrend. In the world of technical analysis, identifying bearish signals is crucial for timing market exits or establishing short positions. A key bearish signal in the double EMA strategy occurs when the shorter period EMA crosses below the longer period EMA. This bearish crossover is commonly referred to as a death cross and is a significant warning sign for traders. When the faster EMA crosses below the slower EMA, it signals that recent price action is turning more bearish than the longer-term average, indicating increasing downward momentum. Traders typically use this signal to execute two primary actions: exiting existing long positions to protect profits or limit losses, and potentially entering new short positions to capitalize on the expected downward move. Unlike the bullish crossover, the death cross suggests caution, especially in strongly trending markets. It's important to confirm this signal with other indicators to reduce false signals during periods of consolidation. The double EMA strategy performs exceptionally well in trending markets. Let's examine a strong uptrend and how the EMAs behave. During strong trends, we add two exponential moving averages with different periods. The key observation in trending markets is that the shorter EMA maintains a consistent distance from the longer EMA. During the strongest part of the trend, the EMAs rarely cross. This pattern helps traders stay in profitable trades longer. Without the double EMA strategy, traders might exit prematurely, missing significant profits. By waiting for the EMAs to actually cross, traders can capture much more of the trend and avoid premature exits. To summarize, the double EMA strategy performs exceptionally well in trending markets because the EMAs maintain consistent spacing, rarely cross during strong trends, and help traders maximize profits by staying in profitable trends longer. In ranging markets, the double EMA strategy faces significant challenges. Ranging markets occur when price moves sideways within a defined channel, without a clear directional trend. When we apply the double EMA strategy to ranging markets, we can see the fast and slow EMAs. The problem becomes apparent as we notice frequent crossovers between the two EMAs. As price oscillates within the range, the EMAs cross repeatedly. This creates numerous trading signals that would typically indicate entry points. However, in a ranging market, these signals often result in false entries and quick reversals. To improve the double EMA strategy in ranging markets, traders often employ additional filters to avoid taking trades until a clear trend emerges. One common approach is to add an oscillator like the Relative Strength Index, or RSI. The RSI can help identify when the market is overbought or oversold. A simple filter strategy might be to only take bullish signals from the double EMA when price is in oversold territory, and bearish signals when price is overbought. Another approach is to simply wait for the market to break out of its ranging pattern before applying the double EMA strategy. This means looking for price to break above resistance or below support with increased volume. Some traders choose to use entirely different strategies during ranging markets, such as range trading techniques that capitalize on the predictable boundaries. In summary, while the double EMA strategy works well in trending markets, it requires additional filters or alternative approaches in ranging conditions. The double EMA strategy can help optimize entry timing, not just identify trend direction. Most traders are familiar with using EMA crossovers as entry signals, where the fast EMA crosses above the slow EMA for bullish entries. Here we can see a bullish crossover, where the fast EMA crosses above the slow EMA, signaling a potential uptrend. While many traders enter immediately at the crossover, a more optimized approach is to wait for a pullback to the slower EMA before entering a position. When you wait for a pullback to the slow EMA after a crossover, you typically enter at a more favorable price. This approach often provides a better risk-reward ratio. As you can see, the pullback entry offers a significantly better risk-reward ratio compared to entering immediately at the crossover. Here's how to implement this entry timing strategy effectively with double EMA. By waiting for this pullback, you reduce your risk while maintaining the potential reward, resulting in a more efficient trading approach. Double EMA strategy can be applied across multiple time frames for more effective trading decisions. Many traders use a multi-time frame approach. Higher time frames like daily and weekly charts help determine the overall trend direction. Lower time frames such as hourly and 15-minute charts then help fine-tune entries and exits while staying aligned with the larger trend. Using the same EMA settings across timeframes creates consistency in your analysis. On a daily chart, the double EMA crossover confirms a larger bullish trend when the faster EMA crosses above the slower EMA. The hourly chart reveals more detail while maintaining the same overall trend. Multiple smaller crossovers provide specific entry and exit points. A practical double EMA multi-timeframe workflow involves 4 key steps. First, check the higher time frame to confirm the overall market direction using the double EMA crossover. Then, switch to a lower time frame while maintaining the same EMA settings. Look for double EMA crossovers on the lower time frame that align with the higher time frame trend. Finally, use these aligned signals for precise entry and exit timing. To maximize the effectiveness of multi-time frame double EMA analysis, consider these key tips. While the double EMA strategy is commonly used in Forex and stock markets, it can be effectively applied across various asset classes. Each asset class has unique characteristics that affect how the double EMA strategy performs. Let's examine these differences. The most significant factor that varies across asset classes is volatility. Forex markets tend to be less volatile, while cryptocurrencies exhibit much higher price fluctuations. These volatility differences mean we need to optimize our EMA periods for each asset class. Higher volatility assets typically require longer EMA periods to filter out market noise. For low volatility assets like Forex or major indices, shorter periods like 5 for the short EMA and 20 for the long EMA often work well. But for highly volatile assets like cryptocurrencies, we might need to extend these periods to 10 and 30 or even longer to avoid false signals. Here's a summary of recommended double EMA settings across different asset classes. Note how the periods increase with volatility. Let's look at double EMA crossover examples for different asset classes. Notice how the optimal settings vary based on the asset's volatility profile. To effectively use double EMA across different asset classes, remember these key points. While double EMA is universally applicable, your settings should be customized to each asset class for optimal performance. The strategy's principles remain the same, but the implementation details matter. Backtesting the double EMA strategy is a crucial step before risking real capital. Backtesting allows you to validate your strategy and understand how it would have performed in the past. The backtesting process follows a systematic approach to evaluate your trading strategy. During backtesting, you'll analyze how your double EMA strategy would have performed with historical price data. Finding the optimal EMA periods is a critical part of backtesting. Different EMA combinations can produce significantly different results. When analyzing backtest results, focus on key performance metrics that indicate the quality of your strategy. A robust double EMA strategy should be tested across different market conditions to ensure it performs well in various scenarios. Before implementing your double EMA strategy with real capital, remember these key backtesting principles. A common mistake with the double EMA strategy is overtrading during ranging markets. When price moves sideways, the fast and slow EMAs stay close together, crossing frequently but producing low-quality signals. Traders often make the mistake of taking every crossover signal, leading to multiple small losses as the market lacks directional momentum. Instead, be patient and wait for stronger trending conditions. Another critical mistake is ignoring the broader market context when trading with double EMAs. Here, we see a bullish crossover signal appearing, which might seem promising in isolation. However, when we examine the broader context, we see this signal occurs against a strong downtrend and just below a significant resistance level. By ignoring these contextual factors, traders often enter low-probability trades that quickly fail. The third major mistake is failing to implement proper risk management with the double EMA strategy. We'll compare poor versus proper risk management approaches. With poor risk management, traders often risk too much capital per trade and fail to use stop losses. A series of losses quickly decimates the trading account. In contrast, proper risk management limits exposure to just 1 to 2% per trade and always uses stop losses. This approach preserves capital through losing streaks and positions you for long-term success. The final common mistake is abandoning the double EMA strategy prematurely, often after experiencing a series of losing trades. Many traders quit during the initial drawdown period, precisely when the odds are about to turn in their favor. Successful traders evaluate strategies based on hundreds of trades, not just a handful. Taking a statistical view of your double EMA strategy allows you to see past short-term losses and focus on the long-term edge that a well-tested approach provides. To succeed with the double EMA strategy, remember that consistency beats perfection. Trade with the trend, not against it. Consider the broader market context. Always manage your risk. And evaluate performance over hundreds of trades, not just a few. The double EMA strategy has demonstrated its effectiveness in various market scenarios, particularly during significant market events. Let's examine its performance during the 2020 market crash and subsequent recovery, one of the most volatile periods in recent market history. Adding our double EMA overlay, we use a 20-day short EMA shown in teal and a 50-day long EMA shown in red. As the market began to crash in late February and March, the double EMA strategy generated a sell signal when the short EMA crossed below the long EMA. This bearish crossover would have prompted traders to exit positions or enter short positions, potentially preserving significant capital during the 25% market decline. As the market began recovering in the second quarter, the strategy identified a bullish signal in July when the short EMA crossed above the long EMA. Traders following this signal would have re-entered the market in time to capture most of the recovery gains throughout the remainder of 2020. Let's examine the performance metrics of this strategy compared to a simple buy and hold approach. A buy and hold strategy would have resulted in an 18% loss during this period. In contrast, traders using the double EMA strategy could have achieved a 12% gain while avoiding the maximum drawdown of 25%. The double EMA strategy has also performed well in various other market scenarios. Let's briefly look at some other successful applications. In the tech sector, this strategy generated a 32% annual return between 2019 and 2022. For gold, it successfully captured the 2020 to 2022 bull market. And in forex markets, it identified major trend changes in EUR-USD pairs. In conclusion, the double EMA strategy has consistently demonstrated its effectiveness in identifying trend changes and preserving capital during volatile market conditions.